Rowan Smith with the Mortgage Center. My most commonly hit blog topic of all time, consistently, is talking about former marijuana grow operations. So I'm going to do another one that's going to cover a little bit more detail. And for those of you that are not in the Vancouver market, that perhaps are in the Toronto and Ontario market where they're not used to dealing with these things, this can serve as a guide for how best to proceed to get the best financing rates for you and your clients. So a former marijuana grow operation doesn't just have to have been currently a grow op for the prior owner. It could have been the owner before them or the owner before them. So when you buy a property, if you're using a realtor, there's usually a disclosure statement or something where they ask, has the property ever been used as a former marijuana grow op? If it has, and it's in BC anyway, that person has to declare that it has been used as such. And why? Because a lot of times that can compromise the value of the security, which is the home for the bank. A lot of banks, Scotiabank for example, simply will not do a former marijuana grow op. Doesn't matter if you have 50 or 65% down. They're not interested in that business. They'll get it elsewhere and they'll leave it for somebody else. The more common credit unions are the ones that are doing them. There's a couple of the big banks will, but they require different things such as environmentals. So if you're looking to finance a former marijuana grow op, here's the things you're going to have to understand. You will be required to get an appraisal of that property. Guaranteed. Every bank's going to ask for it. Number two, you're going to have to provide some sort of environmental study confirming that the property is still fit for human habitation. Now, what that means is there's two types, and there's many types of environmentals, but the most common are a phase 1 or just a level 1, and that's a air quality test. What they're looking for is mold. Make sure there's no toxic mold in the property, because people can bleach walls and paint them white with kills and other stuff to get rid and hide the fact that there was a grow op in the property. So what they do is they take an air test where the grow op was in the house, they take an air test where the grow op was not in the house, and they do another test outside as a kind of a control. And they look and make sure that there's not a massive variance between the levels of mold within the property, and if it's within the tolerable limits. The second thing is some banks are going to want a phase 2, where they actually take drywall samples and samples of materials to make sure that not only is the air clean, but there isn't chemical leaching or other possible environmental problems. Banks have to keep an eye on the fact that the property that they're financing could represent a future environmental liability to you, the buyer, and by extension to the bank, because you may not be able to take care of environmental damage. You may be thinking, well, what environmental damage? And the reality is most grow ops don't have any environmental damage. They're usually confined to a single room or a shop or whatever. The bank doesn't care. You still need the appraisal, you still need the environmental, because to the bank, a grow op's a grow op's a grow op. All right? So if you're looking at one of these properties, you can bank on needing extra time to get your financing put together. You're going to need at least 7 business days. You're going to need to get an appraisal in there. It can be done in 2 or 3 days tops, but the environmental is the wild card. Now if the property is rural, just start tacking on days and start tacking on costs. Appraisal is going to be about $275, and an environmental is going to be probably $1,000 if you're in an urban location. If you require travel time, I've seen them go as high as $5,000 for a more remote property. These are the requirements that you're simply going to have to deal with. And people will say a lot of times, well, won't the bank do it because I'm putting 50% down? I mean, where's the risk? And the risk is that there could be a future liability that has nothing to do with where's the risk in your mortgage, but where's the risk for the property should an environmental contamination problem exist. And if the property was used as a wholesale grow op where they had holes chopped in the walls, where they had sprinklers installed and there was humidity issues and possible black mold, chemicals for accelerating growth and all this type of thing, in these circumstances there could be leaching into the ground, into the walls, you could be breathing it in, and it might not be a problem day 1, day 2. Come year 1 and year 2 and you've got a constant chronic stuffy nose and headache, and these are real possibilities, that's where the remediation, the fixing, can become very, very costly. Now, if you don't have the money to do that remediation, the bank's going to have to do it if you just try to walk away or something like that. So you can bet there's going to be a ton of due diligence done by the banks on these properties. I have a whack of experience, a wealth of experience in using various institutions to finance these type of properties. When all else fails, we do have access to private lenders, some of them exclusive only to myself, who will finance a former grow op because they realize that the risk is actually quite slim and perhaps the banks are maybe overreacting, maybe the pendulum has swung a little too far against former grow ops. If it looks like it's too good of a deal to be true, and you find out there's been several collapsed offers already, it's probably because there isn't an environmental and people aren't willing to spend the money. But a recent example of a client of mine was they found a property for sale. It was a former grow op. They bought it by way of a private sale. They knew it was a former grow op. They put 30% down on a purchase of about $276. They spent $100,000 repairing the property, so $376. They sold it for $600. That's a pretty good profit margin. Now, not every deal is going to be like that, But when you're dealing with possible gains or massive discounts, don't cheap out on $2,500 to get this done with an environmental and do it properly. Get yourself the proper financing up front, deal with somebody who knows what they're doing, and will take the stress out of this, will make it easy. For the Mortgage Center, I'm Rowan Smith.